If you're new to the share trading scene, a skill that's going to be of importance to you is learning how to value a stock. There are many options available, so arriving at the one that suits you best will be a magic lesson learned. Think of it as shopping for cereal in the supermarket. First step is to explore various brands available, moving to other important aspects like containers, flavours, price. Similarly, while choosing a stock, investors must understand all the dynamics and value in it before spending their hard-earned cash. Now, valuing a stock can help investors understand if the price is low or high compared to the company's performance and growth outlook. So, without wasting any more time, let's get started with understanding how to value a stock. There are two main methods used to value a stock: technical analysis, fundamental analysis. You may have heard of them already. Let's find out a bit more about technical analysis. So technical analysis is the study of price actions which is based on the major assumption, this is, freely traded markets travel in a trend. And despite a lot of advancements in the field, the primary goal of the field remains the same. Identify the trend as early as possible, capitalise on it for as long as possible, and manage the risk along the way. Now, whereas fundamental analysis is a method to evaluate the intrinsic value of a business through evaluating the financial, economic, qualitative and quantitative factors. It's usually applied when investors seek to invest in a business for the long term. However, special situation investing such as buybacks, rights issues, merger and acquisitions and even more also call for using knowledge of fundamental analysis to make profits in the short term. Let's now take a look at a few ways of determining a stock's relative value. First, the price to earnings ratio. This is the ratio of a company's share price relative to the earnings per share, which is generally for the last 12 months or annually, also known as earnings multiple. It's widely used by market participants while referring to valuations. It also reflects the current investor demand for any particular stock. Next is the price to book ratio. This is a valuation multiple depicting the market's perception of a particular stock. It evaluates the market value of the stock or per share in comparison to its book value. It can also be termed as the market to book ratio or P/B ratio. In other words, this ratio can also be interpreted as the company's net assets compared to the sale price of the stock. And the last method is the price to earnings to growth ratio. And this is defined as the price earnings ratio divided by the expected growth rate in earnings per share. PEG ratio is a function of the risk growth potential and payout ratio of the firm. The riskiness is assessed based on beta value. As risk increases the PEG ratio of a firm, it will decline. Thanks for joining us on the report. Now, if you do like the information, please give it a like, share, comment on the video below and subscribe to the channel. Press the bell icon, you'll be notified of the most recent videos from Kalkine. But for more articles, do head to the website, it's kalkinemedia.com. This is Sage for Kalkine Media.